What's going on, everybody? Monday, August 18th. Quiet action today in the market. Friday was a big day. Flows. I was telling you guys about this leading up to it because Friday we had a quarterly interest payment. So it was a 104 billion leading flow and an 85 billion net flow with a 75 billion quarter interest payment. And in the last interest payment in May was a 72 billion, and last August 2024 it was a 62 billion. So you see these quarterly interest payments are going up. So if you look at the flows right now, I mean, it's just a freaking straight line up. So that's bullish. You got to buy until that trend changes. And I don't know if it will, but I've been mentioning the tariffs and the fiscal drag that's coming from that. Next year, with the Treasury issuing more T-bills now, we'll have much sharper declines in interest income transfers, or that could add some fiscal drag in 2026, but that's still a way off. So right now, until those trends in the fiscal flows change, and I don't know if they will for the remainder of this year. I mean, I'm still aware of October 1st and the last 3 months when we might see some impact from those government employee resignations, the end of those federal salaries, stuff like that. But right now, it's an easy call. I mean, I said we were going to peak out in the flows for this quarter on Friday, which is what happened. I said we're probably going to have a shallow correction. The market stalled a little bit today. I mean, that might be it, because Wednesday we have a Social Security payment, and then before you know it, we're going to be at September 1st of the month payments, which is going to be another 100-something billion. These numbers, guys, I don't think you understand. I mean, there was a time that I could recall, maybe in the first, not the first Bush, but George W. Bush. Bush was at 43. In his administration, when we would get 200 billion flows for the entire month, and that was considered like huge. Now we're getting 100 billion flows in a single day. I mean, think about that. So people who are using metrics on the stock market, these kind of valuation metrics, the PE of the S&P and stuff like that, that may all be true based on historically how these metrics have been viewed. But I mean, when you're looking at the amount of these flows, the magnitude of these flows, I've used the word tsunami in the past. It's really what it is. It is, I mean, it's incredible. There's so much income being transferred into the economy. Now, some people, they might not like to hear that. They might even get upset at me saying that. And I understand, because that's definitely not all distributed equally by any means. But I mean, again, if you use the swimming pool analogy, that water keeps going up. So I mean, it's very bullish for risk assets. That would include, of course, stocks, which is what I talk about, gold, crypto, and I would even say oil. You just got to be a little bit patient on that. Now, this week, I get a kick out of this because it happens every year, and I just sit back and watch, and I laugh. The Jackson Hole Symposium is happening this week. That's when all these central bankers, including Powell, they go out to Jackson Hole. and they have a conference, and everybody in the financial business and analysts and traders and people who follow the markets, they're all, and the media, they're all talking about this. Oh, the Jackson Hole, what's Powell going to say? What's Powell going to say? This is, to me, it's just another example of this mental illness of monetarism. Like this microscopic, this tunnel vision focus on monetarism. What's Powell going to say in Jackson Hole? Like, I don't give a crap about that. I don't pay any attention to that whatsoever. For the reasons that I've explained in the past, I know what rate adjustments are. Okay, they're price adjustments and fiscal operations. I know the impact of those things. The Fed has very little control over the general economy. That's all driven by fiscal and to a degree also credit creation, which is like the second derivative or the first derivative off of fiscal. So, and by the way, credit creation can only persist for a period of time. The other impact, I would say now, coming into the picture for the first time in a very long time, even though it's at its very nascent stages, that would be trade. All right, if Trump is successful in transforming the U.S. economy from a consumer-based into a producer-exporter, but that's going to take time. But I do see small evidence emerging that it's starting to move in that direction. And that will constitute a very important trend over the long term if it continues. So it has caused me to make a few adjustments in my analytical framework. That doesn't mean I'm going off of the flows. Absolutely not. But I'm starting to include some other things. So yeah, they're all freaking out about this stupid meeting. And here you have a group of people, these central bankers, who operate on an orthodoxy that they don't even really understand, or I could even say that they have backwards. Okay, who in their right mind thinks that higher interest rates, when you raise interest rates on things, I mean, just think about if you want to buy a house or if you want to buy a car, your financing cost goes up. The price effectively goes up to you. Yet these guys, they all come from a viewpoint that somehow that brings prices down. And vice versa. We all know when rates are cut, it makes housing what? More affordable. All else equal, all right? We've got to talk about supply too. But I mean, like, your payments are less. Less means lower. But these guys operate on an institutional framework, an orthodoxy, which is completely backward. And you have the whole world, or at least, the whole entire financial community, including investors, micro-focused on what these guys are going to talk about in some, posh freaking symposium for a few days where they're treated like these, gods of the universe. I mean, it is so ridiculous and so idiotic that for me, I just got to look at this and laugh. It's comical. The whole thing is comical. I mean, how this belief system has been elevated to the point, to the exclusion of everything else, where the only thing they talk about, whether it's on these TV shows or online or in the media, in the print media, anywhere, the only thing they talk about is what's the Fed going to do? What's the central bank going to do? And it's really just the Fed. You never even hear it about. You basically don't hear anything about the ECB or the Bank of Canada or the Bank of England. It's always the Fed. What's the Fed going to do? What's the Fed going to do? It is the most idiotic and ridiculous thing that I have ever seen. It is a completely useless endeavor to be focused on this all the time. It does absolutely nothing for you. Now, understanding the impact of monetary policy, as I try to teach here, that's useful, okay? That's useful. But taking it kind of at face value from the establishment and the way it's portrayed just puts you on a path to losing. I'm sorry, you don't understand it correctly. And this fixation, like constantly in the media, in the news, this fixation, what's he gonna talk about? The other thing I've been hearing about now is, and this popped up in the past, but it's popping up again, this stupid idea of yield curve control. Now this is you know how they used to talk about the inverted yield curve, and I told all you guys it was bogus, it's ridiculous. You know, it was based on a completely inapplicable understanding that really went back to the days of the gold standard, you know, loanable funds, where there's only a finite amount of funds. We don't have that setup anymore. You know, and they always go from, that persisted for 5 years, and they always used to say, that is the ironclad predictor of a recession. Oh yeah, well, it went on for 5 years, we never had a recession. I mean, and then when the yield curve started to steepen, then they flipped around and they said, now that's the real indicator of a recession. I mean, these guys, you got to think about this. This is crazy shit. I mean, if you follow this stuff, if that's your thing and you think you're getting informed, I mean, this is just insanity. So now it's yield curve control. This is their big thing. And it's, oh no, you better get ready. I saw one guy who's an analyst at Bank of America, this guy Hartnett, I think his name is. He said, you better buy gold and crypto right now because the Fed is going to do yield curve control. First of all, what is yield curve control? When they talk about it, when these people talk about yield curve control, they're basically alluding to the idea that the Fed may want to set rates at some point along the curve, maybe at the longer end, not directly, but indirectly. And I'm like, hello, it does that just by the very fact that it is the rate setter. Yield curve control is happening all the time by virtue of the fact that the shape of the curve, or let me put it this way, rates all along the curve are nothing more than a reflection of Fed policy over that term. So like rates at 2 years would be a reflection of Fed policy over a 2-year period. Rates at 10 years would be a reflection of Fed policy, you know, longer out. So the very fact that the Fed is the rate setter, the monopolist rate setter, by definition means it's controlling the curve. So this is nothing new. Okay, but anyway, this guy says you better buy gold and you better buy crypto. Meanwhile, why is he saying that? Because he's inferring or alluding to the fact, like, if the Fed's going to bring interest rates down, then you better buy these things. Meanwhile, we've had a period now where the Fed has kept interest rates, real interest rates are among the highest in the world, or the highest among industrialized countries. And what has that done to gold and crypto? They've been setting new records almost daily, okay, with high interest rates. And now this guy, with Bitcoin at an all-time high, with gold, you know, not far off from an all-time high, saying, now's the time you gotta buy gold and crypto. I mean, where's he been for these last few years when rates have been the highest of any industrialized country and all we've had was bull markets in gold and crypto? I mean, these guys, it just blows my mind that they have jobs, high-paying jobs on Wall Street, that they're considered knowledgeable, that they're, you know, brought on TV or quoted online or in the news somewhere, talking about shit that they absolutely don't understand. And this is why I'm telling you, and I've spent my whole entire career on Wall Street, 4 different exchanges, worked for some banks, and I can tell you, like, the only reason that they make money is because they're market makers. It's not because they're savvy in forecasting markets. They're terrible at that. The reason why they make money is they're market makers. They put deals together and they pad in either commissions or some spread in their favor. And I'm not taking anything away from them for doing that. You know, I guess you could say that's their function. That's their business. That's what they're in business to do. But other than that, and they're great money raisers, and they always take a percentage off of any money that they raise. But in terms of their ability to forecast, I mean, how many times, if you just look at individual stock recommendations when they downgrade or raise the outlook on a stock, most of the time, if you go against that, you're going to make a lot of money. You know how many times I can remember where they've downgraded stocks? I mean, I can think of a couple off the top of my head. J.P. Morgan a few years ago, Meta, you know, the old Facebook stock. I mean, there's been a bunch of them when they downgraded them, and you know, people idiotically listened and sold, and those were fantastic buying opportunities in those stocks. Don't pay any attention. Wall Street is a big business because it knows how to gather assets, okay? And it knows how to put deals together. It's not a big business because it knows how to forecast. And you could tell when they, you know, wheel out these guys, these analysts, and put them on TV, and they talk about stuff, and it's completely nonsensical. Like the guy's saying, oh, you better get ready, yield curve control, buy gold now, I'm not saying don't buy it, but I mean, I'll tell you this. If these fiscal flows start to decline, maybe later this year, maybe next year, gold, crypto, going down. And you could write that down right now that I said that. What's today? August 18th, 2025. Anyway, that's it for today, folks. Thank you for watching. Please hit the like button and subscribe. And don't forget, go to my website, pitbulleconomics.com, and sign up for a 30-day free trial to MMT Trader. See you tomorrow. Bye.